This is the big interview. Welcome.
Thank you.
What made you get into this industry? What was the catalyst for you as a young man deciding to become a fund manager?
Well, I've always been on the buy side of asset management in my career and always been in fixed income, and I've been doing this now for over 25 years, so I've really actually enjoyed those 25 years. And I guess some of the initial reasons of why I got into this career was really because I love this idea of being constantly measured about what you do. So you're making decisions every day or every week or every month, and actually you can immediately see if that decision's a good one or a bad one, because those numbers and those decisions are immediately impacted on performance figures. And that always struck me as a very rewarding way of following a career, and that stuck with me.
Give me a brief overview of what you do as CIO of fixed income here at Fidelity.
Well, as CIO of fixed income, my responsibility is managing the fixed income teams at Fidelity. We're a global fixed income house, so we have large teams in London. We also have a very strong presence in Hong Kong and an increasingly strong presence in Shanghai as well. So my responsibility is making sure the teams in those different areas are functioning well and delivering performance for our clients. So part of my responsibilities is obviously managing the team of portfolio managers that we have, but also all the analysts and the traders, very much those people attached to the investment process. Obviously wedded to that is a close affiliation with our clients to making sure that what we're doing on behalf of clients is meeting their outperformance expectations. So very strong focus on working with the teams, but also working with our clients.
So tell me about the rush for yield in 2017.
Well, there's undoubtedly been a huge rush into those higher yielding parts of the fixed income markets. That hunt for yield has been a really strong theme for several years now, and this year it's continued. So that hunt for yield is a very strong dynamic. People are looking to put more yield and more income into their portfolios, and it's almost as if it's been a non-stop wall of money moving into these asset classes. So that hunt for yield is still a very strong dynamic. The technicals driving the market are still very supportive. So the supply of bonds coming into the marketplace is healthy, but it's actually being dwarfed by the amount of money being put into these types of asset classes. The underlying fundamentals of a lot of the credit markets are okay. Some of these aggregate credit metrics that we looking at leverage ratios or interest rate covers, seem to be okay. So a lot of the fundamentals are relatively supportive for the credit markets. But a big question mark remains around valuations. Because of that hunt for yield, so spreads have tightened across the credit markets, which means that we have to constantly ask ourselves, is there appropriate value in buying these credit markets where spreads are today? And the answer to that is it's a yes or no answer. Yes and no answer, because there's certainly some parts of the market where valuations look far too stretched. But we are still finding opportunities at the individual security level or the individual place of where a bond stacks up in the balance sheet, where we are still able to find value on behalf of our clients. So I think in terms of that hunt for yield, that's still a very strong dynamic, but I think part of the focus has to be now on making sure that security selection is really being carried out in the best way possible. You don't want to be just buying any old credit bonds with valuations where they are. I think you have to be far more selective and do your homework.
What were the defining moments and what were the right decisions that you made to lead you to where we're sat now?
I think one of the biggest sort of piece of advice I'd pass on to sort of younger people was something that was said to me, a bit of advice that was given to me, was just say yes to as many opportunities as you possibly can, and don't think too much about the short-term consequences or short-term disruptions, because actually the experience will be invaluable, because it's changed and it's new and it's exciting, and you'll be able to draw on that experience as your career just develops. And I found that to be very true for me. I think there are sort of a couple of real changes in my career, which I found fascinating, which was actually having some overseas assignments. People, for example, said, well, why would you want to work in continental Europe at that time? And I put my hand and said, well, I very much would like to do that. And I got stuck in and was there for 2 or 3 years, and I absolutely loved it. The first few months were difficult, but I absolutely loved it after that. And I've had overseas assignments as well. So I guess my point is that, especially as you're starting out in your career, just say yes to as many opportunities as you possibly can. Just grab those opportunities, because guess what? They will pay back dividends in the future.
Now, just looking ahead, we're moving towards the close of 2017. It's been a pretty interesting year so far. What have you made of this year so far, and what are you expecting for 2018? And you can be specific about what you're, not necessarily the markets. You can talk about what we can expect from Fidelity during that period as well.
I think if I look back on 2017, as we speak, it's so far volatility has remained remarkably low within markets. An awful lot has been chucked at investors, as you rightly say, and yet markets have responded in a relatively calm way so far. Now, who knows what will happen in the next few months, but it actually has been very calm so far. As we go out into 2018, there will always be question marks around what's going to be the future for fixed income, and this has been a question that we as fixed income investors have every single year, almost for the last God knows how many years. Is this the end of a bond bull market? Now, we strongly believe it's 2018 is not going to be the end of a bond bull market, and people will point to the fact that, well, the Fed will be raising rates, will be QE tapering and so on. And I think that's right, but I think people shouldn't forget the fact that there are some serious structural issues in the global economy, such as the amount of global debt is just staggering. The amount of aging populations and the demographics and what that means for keeping yields low is really quite significant. We shouldn't forget it. We also have the fact that productivity levels remain very low. So I think despite the definitely a view that global economies are recovering, and that's a good thing, but there are significant structural issues still at play which will dampen a huge rise in interest rates and a huge rise in yields. So we still remain constructive for fixed income markets, which means the question about duration should therefore people move all their money out of bonds and into cash. We think that that's probably not the right thing to do. Cash really isn't king. It's just yielding such miserly levels. We still think there are opportunities within fixed income, and also one mustn't forget that by giving up on duration, you are also giving up on your diversification benefits compared to equities. The great thing about having duration in one's bond portfolios is it acts as a great insurance hedge against what might happen in the equity market. So in terms of a balanced portfolio context, fixed income and duration still have a major part to play.
Who says bonds are boring?
Not me.
Thank you very much. It's been a really interesting chat. Thank you for your time.
Absolute pleasure. Thank you.